Hi, my name is Victor Olamide Atunda. I'm a tax preceptor with over 6 years of experience in teaching taxations and helping individuals and businesses on tax matters. On the 26th of June 2025, the President of the Federal Republic of Nigeria, His Excellency Bola Ahmed Tinubu, signed into law the Nigeria Tax Reform Bill, which comprises of 4 key acts. The Nigeria Tax Act, which outline the taxes that are required to be paid. The Nigeria Tax Administration Act, that specifies who administer the tax. The Nigeria Revenue Service Act, which replaces the FRS Establishment Act to better reflect the roles of FRS in collecting revenue for the Federation and that of the federal government. And the last one, which is the Joint Revenue Board Act, which ensures coordinations and collaboration among revenue authority across Nigeria, providing a platform for sharing information, ensuring data integrity, and preventing multiple taxation. The effective date of this reform is 1st of January 2026. It is important to note that this tax bill is a reform, not the introduction of a new tax. The reform seeks to clarify existing tax laws, eliminate multiplicity of taxes, ensure all taxable persons are brought into the tax net, reduce the tax burden on the masses, promote a modern, business-friendly, and globally competitive tax system. Many individuals and businesses have asked me questions about this reform. In this video, I will address these questions and explain the tax law in a clear, practical manner. For clarity, I will regard the current provision as the pre-reform provision and the new tax bill as the reform provision. Let's start addressing the question one after the other. Is a tax identity mandatory for every Nigerian? No. Tax identity is only mandated for taxable persons. Not every Nigerian is a taxable person. For instance, students who do not engage in economic activities or businesses are not required to have a tax identity. However, when a student engages in businesses or other economic activities, they are mandated to have a tax identity. And also, even though you are a non-taxable individual, you may voluntarily obtain a tax identity ahead of the time when you become taxable. It is also important to note that taxable persons are not limited to Nigerian citizens. Non-resident individuals and overseas companies can also be taxable person. Who is a taxable person? A taxable person is an individual or corporate entity who earns income in Nigeria, brings income into Nigeria, or has a permanent establishment or a significant economic presence in Nigeria. For instance, Microsoft offers cloud services, subscriptions, or digital products used by Nigerians. So because they have a permanent establishment or significant economic presence in Nigeria and also earn some income in Nigeria, they are taxable in Nigeria. Section 8, Subsection 2 of Nigeria Tax Act 2025 mandated it for every corporate entities and financial institution, including banks and stockbrokers, to request tax identity from their customers. If tax ID is not mandated for everyone, how will the banks know who is taxable? And will government tax the cash inflow into my account, or will the government monitors my account? All right, let me quickly address this question. When you open an account with the banks, you've already provided banks with enough information for them to know if you are taxable or not. However, the Section 29 of the Nigeria Tax Administration Act provides that when an individual have a transaction within a month over a 25 million naira, such account should be flagged. At the same time, in the case of a corporate entity, any transaction within a month with such account over 100 million naira and for 100 million naira and above, such accounts should also be flagged. All right, is the cash inflow is going to be taxed? No, cash inflow are not automatically taxed, but government are going to be monitoring accounts and also trace the source of the income to check if it's taxable or not. How do you register for your tax identity? All right, to register for your tax identity, visit the site below. The next question, as a market woman or informal sectors workers with limited record keeping, will you also be taxed? Yes, you will be taxed. And if yes, how will the tax payable be determined? All right, according to Section 29 of the Nigeria Tax Act 2025, where for all practical purposes, the chargeable income of an individual cannot be reasonably determined, the presumptive tax regime is made available to subject such individuals to tax. And what is presumptive approach? Presumptive approach or tax regime is a situation whereby we presumed or estimated the amount of tax you are going to be paid. You are going to pay. That's to understand more about this, see section 29 of the Nigeria Tax Act 2025. And also, let me give an example of this. What really happened, we see some cases in respect to Pella, Opeyemi Famakin, Yabo Ojo. They are being subject to tax by the Lagos State Internal Revenue using presumptive approach. So their cases are more or less like that of presumptive. And how will the government use this presumptive approach? Let me just give you an instance. For instance, you sell at Oshodi Market. Government, we are going to look at, okay, what is the average sales made in Oshodi Market for this kind of products? And what is the average profit made at Oshodi Market for this kind of product? All right, if this average sales is this, and on average, what is going to be the amount at which this individual is going to pay? But it is better for you to make a proper record of all your transactions. You may be taxed more than the amount that is supposed to be subject to tax. But if proper record are being kept, then you are going to what? You are going to tender your what? Your receipt and all other documents so that you are not going to be overcharged. Because there's what we call a threshold of 800,000 naira. Anybody earning less than 800,000 naira threshold will not be subject to tax. So you may fall within that range. For you not to be overcharged, you're supposed to keep your what? You keep proper records. Please, sir, can you take us through the tax reform and the changes, most especially personal income tax? All right. Identified changes to the personal income tax are the following: changes in the tax band and the rates, the replacement of consolidated relief allowance with the rent relief allowance, reform of the tax exempted items as the eligible deductions, and at the same time, the mandatory filing of returns for all taxable persons. For instance, before, employees are not mandated to file their returns individually, but now, under the new tax reform, every employees are expected to file their own returns. Other changes that are identified changes is the integration of the capital gain into the personal income tax. According to section 28, subsection 1 of the Nigeria Tax Act 2025, total income of an individual for any year of assessment is the taxable income less the total deduction. What is taxable income? According to section 28, subsection 2A of the Nigeria Tax Act 2025, total income is the aggregate amount of assessable profits from trade, business, profession, or vocation. Employment income, income from investing activities, profits or income from other sources of income, chargeable gain from disposal of chargeable assets. Let's explain them one after the other. The assessable profits from trade, maybe you are into selling of foodstuff, or you are into selling of provisions, or you are a sole trader or partners in partnerships, or you are into a profession as a doctor or as a barista that provides professional services, or you are into vocational activities like barbing, hairdressing, basket weaving, and the likes. Employment income include income from employment, that is under income you earn as a result of contract of employment as an employee. This income includes the salaries, the transport allowance, the housing allowance, other cash emoluments, and benefit in kinds. All this income constitutes employment income, including pensions and gratuity. Pension and gratuity are form part of employment income. However, they are also exempted if those income, pension and gratuity, are made in accordance with the provisions of the Pension Reform Act. They are also exempted. We are going to see how this is going to be accounted for in practical scenario. Income from investing activities. These include dividend received, royalty received, rental income received, and also profits or others from other sources of income that are not mentioned above, and chargeable gain. Initially, chargeable gain from disposal of chargeable assets are captured under capital gain tax. However, the new provision provides that all the capital gain tax now are to be captured under income tax. In respect of an individual, any capital gain arising from chargeable assets are to be what? Are to be considered under the what? Under the personal income tax. So So they are not going to be taxed under personal income tax provision, no more under capital gain tax. Even though the computation is going to be made to get what is going to be the chargeable gain on that chargeable asset, then this chargeable gain is now going to be captured under the total income of an individual for tax purposes. Section 28, subsection 2B of the Nigeria Tax Act 2025 defined what constitutes the total deductions. The total deduction is the sum of any loss ascertained in accordance with Section 2. That is, when you organize or in your business, you make a loss, such loss should be what should be deducted. Capital allowance in accordance with the provisions of Part 1 of the first schedule to this Act, and at the same time, income of the individuals that is exempted from tax under this Act. That is, we have some income such as pensions that are made in accordance with Pension Reform Act or Pension Reform Act. At the same time, gratuity that is made in accordance with the provisions of Pension Reform Act is also tax exempted. So another one is income of the individuals on which the tax deducted at source under Section 51 of Nigeria Tax Administration Act 2025 is the final tax. That's what we refer to as the frank investment income, like dividend, which has already suffered withholding tax. Dividend received, net withholding tax is a frank investment income, and that's the final tax payable on it is withholding tax. So it shouldn't be subjected to further tax. So this income are exempted. This income are considered part of the total deductions that are to be what? To be made to get the total income of the business. So, or the total income of the individuals, rather, the total income of the individuals. What is now chargeable income? Chargeable income, according to Section 30, Subsection 1 of the Nigeria Tax Act, is the total income less eligible deductions. And what is eligible deductions? According to Section 30, Subsection 2A of the Nigeria Tax Act 2025, eligible deductions include the payments made by an individual in a year of assessment in respect of the contribution made to the National Housing Fund contribution, the contribution made to the National Health Insurance Scheme, Pension Reform Act, and the tax on loan for developing an owner-occupied residential house, which we consider as interest on mortgage loan, and at the same time, a life assurance premium which is incurred on your life, on the life or on the taxpayer's life, or on the life of the spouse. And at the last one, which is the rent relief allowance, which is the 20% of the annual rent paid subject to maximum of 500,000. Please let me explain them one after the other. Prior to the reform provision, most of these items are considered as tax exempted items, and they are generally allowable deductions, and they do not require written written claim before they can be claimed. But these eligible deductions, before they can be claimed, the claimant had to make a written claim. According to Section 31, Section 31 of the Nigeria Tax Act 2025. So this deduction shall not be allowable under this part to any person for a year of assessment unless claim is in written in such form as prescribed by the relevant tax authority. So before this eligible deduction can be claimed, such claimant must make a written claim to what? To the relevant tax authority. Suffice to say, prior to the reform provision, eligible deductions are considered as tax exempt items, and they are generally allowable for deductions without being claimed, without any claim in written. But under the reform provision, they have to be what? They have to be claimed in written before they can be granted. And let me also highlight what are the difference between these eligible deductions and tax exempt items. In the reform provision, that is provision before these reform provisions, the tax exempted item constitutes National Housing Fund contribution, National Health Insurance Scheme, National Pension Scheme, Life Assurance Premium, and gratuity. Gratuity are now being excluded under these eligible deductions in the new reform provision. So gratuity now is a taxable income. However, there are some exemptions to some gratuity. Any gratuity that is made in accordance with the Pension Reform Act, they are excluded as wealth from being taxable. They are called the non-taxable income by exemptions. They are taxable under normal circumstances. They are being exempted because they meet some of the conditions. There are some other gratuity we call death gratuity, or a compensation that is made to a person for disability. They are exempted from what we call from being taxable. So this gratuity now has not been excluded from the eligible deductions. Therefore, they can be considered as part of their taxable income, except they meet some criteria under the exemptions, which we consider as not taxable gratuity by exemptions. Now, it is also important to highlight that there are some deductions that are made in addition to existing eligible exempted items, which we have the interest on mortgage and that of the rent relief allowance. Rent relief allowance is now replacing consolidated relief allowance, which was initially given. Consolidated relief allowance being the 1% of the gross profit, or 200,000, whichever one that is higher between the two, plus the 20% of the gross income. It is now being replaced by the rent relief allowance. And the rent relief allowance is the 20% of the actual rent paid by a person on his what? On his residence that is living. If that 20% is not greater than that of 500,000, you are going to use that 20%. But if it's greater than that of cap amount, maximum amount of 500,000, we are going to use 500,000. Suffice to say, the rent relief allowance, it is the lower of 20% of the total annual rent, or 500,000 naira. We are going to see how these things place in a practical scenario. So to explain better, the National Housing Fund contribution now, which is the 2.5% of the what? Of the basic salary. It is now not a mandatory requirement. However, you can make that what? Make that contribution. It is not a compulsory. It's not more compulsory. You can make that under your discretion. You can make that. It is going to be 2.5% of your basic salary. The National Housing Fund contribution is not mandatory again. So the National Health Insurance Scheme is a compulsory contribution that are expected to be made, which is under the public sector. The federal government is going to be what? Is going to contribute 3.25% of the basic salaries of their workers, and while the workers is expected to what? To contribute the 1.75%, which the total of the two make 5%. But in the private sectors or the non-federal government sectors, non-federal government employee, I mean the private sector's employee, the state government employee, and the local government employee, the employer is expected to contribute 10% of the employee basic salary, while the employee is expected to contribute 5% of the what? Of the basic salary, the total of which is going to be 15%. So the employee is expected to make a statutory contributions of 5% as the National Health Insurance Scheme. While the pension scheme, it is also obligated. These are compulsory contributions. Contributions are to be made to for other pension scheme, 8% contributions. So you can make more than 8%, but statutory requirement is 8%. Whenever you make more than 8%, we are going to consider, okay, the amount, if it's in accordance with the provisions of the Pension Reform Act, is still going to be allowable it's going to constitute eligible deductions. If it's in line with Pension Reform Act and it's made to statutory pension fund. But if you now make a private pensions, aside of that of statutory requirement, it is not going to be it's not going to constitute part of eligible deductions, because it's made outside the what? Pension Reform Act. If it's for instance, you are making deductions, you are keeping the money in your what? In your account as a what? Ahead of your when you retired. Such pensions is not considered. Or when you make a statutory additional contributions to what? To Pension Reform Act in accordance with Pension Reform Act, but it is withdrawn within 5 years. Such is going to what? Is going to consider as non-allowable eligible deductions, which you make in excess. Any amount you make in excess of that required, and you make the withdrawal within 5 years, we are going to consider that as what? Not allowable deductions. Are you with me? So those ones are considered. So the pensions amount you are to contribute as pension, it is 8% of your gross monthly emolument. And this gross monthly emolument is the additions of your basic salary, housing allowance, and your transport allowances. So the next one is life assurance premium. So the life assurance premium amount you contributed as a premium, the premium you paid per it must be for the prior years, that is in the preceding years, that is year before the year of assessment. So any pensions, any life assurance, rather, any life assurance premium that you pay on your life or the life of your spouse are now allowable for deduction. That amount that you incur. But if you paid, that is, you pay a lump sum amount of money, cover for more than a year, those amounts are going to amortized, and the part which is attributed to the preceding years of that year that is allowable, preceding year of assessment, is going to be considered as what we refer to as allowable, what we consider as eligible deductions, rather. Eligible deductions. As I said, gratuity that is captured under the previous provisions, before these reform provisions, are now being scrapped out, are no more considered. So in addition to this, a new gratuity, a new eligible deductions are now being added. We have what we call interest on mortgage loans. Whenever you go for a loan in order for you to build an house whereby you are going to be staying, that loan, interest you incur on that is going to be liable for going to constitute eligible deductions. But if you now make a loan in order to build an house for commercial purposes, it is not constitute part of what is going to be constituted as eligible deductions. And this is only available for any individuals that are what? That are building out, that they are going to occupy. Another thing is that they are also constitute part of this eligible deductions is rent relief allowance. So the Nigerian Tax Act 2025 introduced a new form of personal relief known as rent relief as, replacing the former consolidated relief allowance. Don't forget, consolidated relief allowance is previously the higher of the 200,000 or 1% of the gross income plus 20% of the gross income. But now, the rent relief allowance, starting from January 1st, 2026, rent relief allowance is now going to be applicable, replacing that consolidated relief allowance, which is now going to be either 500,000 or 20% of the annual rent paid. Whichever one that is what? That is lower. Whichever one that is lower. If the 20% that is lower, we are going to use 20%. If 500,000 that is lower, we are going to use the 500,000. So it is also important to mention that unlike consolidated relief allowance that is available for every person, irrespective whether you are a landlord, you own your own house, or you are a tenant. Now, rent relief allowance is only available for individuals that are tenants that incur rent on accommodations where they are staying. But if you are a home owners, rent relief allowance is not available for you. You see that now. We are going to see these implications on that when we are going to see these implications as I'm going to explain what this makes, what this constitutes in our discussion. Let's look into the practical examples of this. Before we consider the practical examples, it is also important to note that If you have to apply for that eligible deductions before that is going to be given to you. So before it's going to be considered for you as eligible. So you are going to make a written statement, making a written claim to the relevant tax authority. Upon that, relevant tax authority may also require some documentary evidence as regards to this claim. So if they are now, okay, this documentary evidence is valid, you can go ahead, they will go ahead giving you that eligible deductions. But if they see it that is not eligible or part of it is eligible, then they will give you that part that is eligible. The other ones may be what? May be considered as non-eligible. So we have to also mention that. So let's go into the practical example. The following information is given as regards an employee. So they gave us the basic salary to be 5 million, the housing allowance to be 1.2 million, and the transport allowance to be 700 million. We have other allowances to be 2 million, and we have benefit in kind as the 3 million, and we have gratitude to be 1 million, making the total of 12,900,000. And they gave us the rent. So rent, we are having a scenario cases because we want to be considering that of the pre-reform provisions and that of the reform provisions to see the variance between them. So let's consider, because rents and the mortgage interest was just included. Let's assume when we don't have rents and the mortgage, what is going to happen to our total chargeable gain, chargeable income, and at the same time to that of in the reform and the pre-reform provisions. So taking it out, you could say that when we see our basic salary, we said the same basic salary, the housing allowance, the transport allowance under the current provision, it is 6,900,000 naira. And then we have other cash emoluments, which we have gratuity, we have allowances. So our allowances, when we add the gratuity and allowances, they constitute other cash emoluments. We had them, they gave us 3 million. This 3 million, adding it to initial 6,900,000, it gave us the total of 9,900,000 naira. So they gave us the benefit in kind. They said our benefit in kind is 3 million. So adding the benefits in kind to get the total income from employment. So the total employment income now is 15,900,000 naira. We did not have any income from other sources like income from trade or businesses or other investment income. So our total income now is going to be 15,900,000. Don't forget, according to definition, the total income is what? Is the total income is the taxable income less the total deductions. And our total deductions that we don't have they don't give us information in respect to total deductions as regards to whether we have capital allowance, whether we have losses and the likes. So what we have now, so our employment income will be our taxable income. That's why we get a taxable income now. So going forward, our tax related items under the old provisions, we have the tax related items, we have national housing fund contribution, the 2% of the basic salary gave us 125,000. That of the national insurance scheme, 5% of it gave us 250,000, and the pension reform contribution gave us the 552,000 naira. This same is applicable to that of the reform provisions. The gratuity is now being exempted from being part of the tax exempted items. So under the new provision, but under this current provision, we still capture it in for us to see the clear pictures of how it goes. So when we get that, then we subtract this tax exempted. The total tax exempted item is 2,77,000 rather. So we subtract this 2,077,000 from 15,900,000. It gave us the gross income. And don't forget, the gross income is income before the deductions of what? Consolidated relief allowance under the current provision. So we have 13,823,000. So our consolidated relief allowance being the 20% of the gross income, which gave us 2,764,600, and plus the higher of either 200,000 or 1% of the gross income. And the 200,000, 1% of the gross income gave us 138,230, and we have 200,000. So the higher of the two is what? Is 200,000. So our total consolidated relief allowance is 2,964,600. So this consolidated relief allowance under the current provision is applicable to everybody, whether you are you are the homeowners or you are a tenant. But now, under the current provision, rent relief allowance is only available for those tenants that incur rent on their accommodations. Do you understand that now? So now we could see the effect that our chargeable income, the total chargeable income under the current provision is 10,858,400. So we've not considered whether there's rent paid or mortgage, because there's no even rent paid, there's no even provision for rent that is paid or mortgage interest under the old provisions. So let's look into the new provisions now under the reform provision. Let's see how the reform provision is calculated. Under the reform provision, we could see that the basic salary, we capture it up to that total cash emolument. They still maintain the same this thing. But when we get to benefit account, we get the total employment income, we still maintain that because there's no changes as regards that. So we don't have income from other sources. So our total taxable income. Now, this is where this comes in now. It is important for us to note. It is important for us to know. You see, the basic salary, we have housing allowances, we have the transport allowances, we have the gratuity amount, which is 1 million, right? The gratuity amount, which is what? Which is 1 million, the gratuity amount, which is 1 million. We have the other allowances, our other allowances, which is 3 million. So addition of everything give us 9,900,000. So we have benefit income of 3 million, which constitutes, when we add two together, it gives us 15,900,000, like that of the total income. If the total income under this also equates the total income under the old provisions. But however, it's not in all scenario that is going to be the same. I said total income rather. That's what will constitute our total employment income. That's not our total income, because don't forget, our total income is what? Taxable income less allowable deduction. So that's our taxable income now. So because we don't have any other income from other sources, that's going to be or constitute our total taxable income. So deducting the non-taxable income by exemptions, we have gratuity, because gratuity is according to the information. Let's assume that this gratuity is made in accordance with the provisions of Pension Reform Act. That is where we are considering it here. So it is constituting non taxable income by exemptions. So this constitutes as a non taxable income by exemption. So we are going to deduct it. So by deducting it from total taxable income, we get a total income of 14,900,000. If you see, under the Reform Act, the total tax, our total income is 15,900,000. But under this Reform Act, our total income is what? Is 14,900,000. The what make this variance is the gratuity, the where the gratuity is being captured. Don't forget, under the current provision, the gratuity is captured as part of the tax exempted items. However, it is excluded from that of eligible deduction, but constitutes part of the non-taxable income by exemptions if it is what? It meets up with the provisions or requirements which is stated under the Pension Reform Act, under the Pension Reform Act. So this, then we have the national, under the eligible deductions, we have national housing fund contributions, we have national health insurance scheme, we have the pension contribution, contribution under the Reform Act, we have the mortgage. So the pension is 8% of the gross monthly emolument, which is the basic salary, housing allowance, and the transport allowance that we calculated. So this gave us the what? This gave us the pension. This gave us what we get for our pensions. Then our life assurance. The mortgage interest, we are assuming there is no mortgage interest, because we want to see what is going to be the effect on our total in chargeable income. And we have the life assurance, it is available for both. And the rent relief allowance, we consider here, there's no rent relief allowance, there's no rent relief allowance. We don't have rent currently. So we are still going to look into it as it's going to be. So we could see that our chargeable income rather, under this reform provision, is 13,823,000. So it is what? It is higher than that of what? Chargeable, that of the current provision. Because of what? Because consolidated relief allowance is available for every individual, irrespective of whether you are what? irrespective of your status. Now, so removal of that consolidated available amount is going to increase our total chargeable gain, our total chargeable income. That's the implication on our what? On our chargeable income. So we will start seeing our chargeable income increasing more than that of what? Under the current provision. So the reform provision, the exclusions of chargeable gain resulted in what? Resulted in our chargeable income to increase when the rent relief allowance is not available, and at the same time mortgage loan allowance is not available. So let's now see the second scenario where there is mortgage, where there is interest relief allowance. Let's start with interest. We don't let us assume that we have mortgage, because it's not in any scenarios. So let's see what is going to be the impact. So if we have rent relief allowance, and don't forget, rent relief allowance, it is said to be, the rent relief allowance is said to be on what? The rent relief allowance is said to be on the it's said to be the it is going to be available for only tenants that incur rent on their accommodations. So let's see the rent. The rent now, we change the rent to 200,000, 2 million, right? The 2 million. So our chargeable gain under the current provision does not change. But if you see under the reform provision, our chargeable gain changes. Our chargeable gain changes. See, we have 13,423,000 naira as a chargeable gain now. So because it is reduced as a result of what? As a result of having the rent relief allowance. And don't forget, what's the rent relief allowance? Is the lower of either 20% of the rent paid. We see the rent paid. They said the rent we paid, the rent we paid is 2 million, and 20% of 2 million is 400,000. So don't forget, the maximum amount is 500. So it's not greater than the 500. So we are using 400 as our rent. So that's what results. Let's change the rent now again. Let's change the rent again. So something around 3 million, let's change it to around 3 million. You see, so our chargeable gain reduces to 13,323,000 as a result of, don't forget here, now let's see here, under our rent paid is 3 million, and the 20% of 3 million as annual rent paid, it is 600,000. And don't forget, it's going to be capped at 500,000 now. So you could see the effects. So notwithstanding, despite this rent relief allowance is available, our what? Our chargeable income is still higher than that of the current provision. You could see the effect now. And don't forget, this rent paid is not available for every individuals. So the same thing, let's check that of mortgage. Let's see the scenario where we have the mortgage. Let's see the scenario. Let's say the scenario we have 500,000 as mortgage. You could see the more we have the mortgage interest, as we have mortgage interest to be 500,000, we have our chargeable gain reduced to 12,823,000. So let's also see another situation. Let's see another situation of mortgage gain when we have, let's say our mortgage gain is now 2 million naira. Let's say that mortgage gain is 2 million. So you could see that we have 11,323,000 naira as our chargeable income. Why? Under the current provision, our chargeable income still remain the same, because our chargeable income still remain the same. So because of that, let's also see the mortgage. Let's say our mortgage increased to 3 million. You can see as our mortgage gain increases, our chargeable gain will continue to what? To decreases. So if all these allowances are available, that's when our chargeable income will what? We reduces. So let's now look another scenario. Let's see what are the tax implications. Let's see other scenario. Another scenario is this. So they gave us different income of what? Of an individual. They gave us different income of an individual. So they said this information of Mr. Victor is provided as follows. It has employment income of 500,000, profit from trade as 1.2 million, the dividend gross at 700,000. They gave us additional information in respect to them. So we have rental income gross at 200,000, and they said our capital gain. So we have scenario-based capital gain. So we have scenario based. We are still going to consider that, and we have the rent paid, the life assurance, and mortgage interest. So these are scenario based. The rent paid scenario based, the mortgage interest scenario based, because we want to see what is going to be the effect on the total income. We want to see the effect on the total income. So according to the information given to us, they gave us additional information. They said Mr. Victor only receives salaries as the only income from employment, and it makes equity contribution to in accordance with the Pension Reform Act to for NHFC, NHIS, and pensions. Okay, so this additional information in respect to that. Go to that pension profit from trade. They said to us that the reported profit is the adjusted profit of its business assessed for tax purposes. So this is adjusted profit assessed for tax purposes. So that's the assessable profit. And then they gave us dividend gross. They said the dividend is gross amount is 700,000 and withholding tax rate already paid is 700,000 and the net dividend received is 630,000. So they gave us the withholding tax, the gross amount is 700,000. So next withholding tax, say it is a frank investment income. We have to consider that. So the rent received, they told us that the rent that was received is the rent received is a net withholding tax, and it is what is 200,000 naira, and then we have withholding tax rate of 10% of the 2 million naira, right? 2 million rather. So the gross income is 2 million and the withholding tax is 10% of the 2 million, which is 200,000, giving us a net received, net interest received, net rent received rather, of 1.8 million. So they report it to us. This is on gross amount. So the capital gain, we have the scenario base. So let's check what is going to be the effect on these businesses. So when we do have capital gain, don't forget the reason why we're having this scenario base is because capital gain is not being constituted as part of the income. Let's assume the personal capital gain is not a part of the income currently, and we want to see what is going to be the effect of these provisions of the new reform on our total income, So let's see that. So we see that the total income, when we have all this information available, we have the tax chargeable gain of 6 million, 5 million rather. For other current provision, it's 5,620,000 naira. 5 million for 620,000 naira, and we have under the reform provision as chargeable income as what 7,275,000 naira. You see, that's increased. So let's now see what is going to be the effect under these reform provisions. Don't forget, our capital gain is not going to affect the current provision, so it's going to affect the new reform provision. So when we put it there, so it's going to be taxed. Normally, initially, the capital gain is taxed in accordance with capital gain tax, and it is 10%. But now the capital gain or the chargeable gain is now being constituting as part of our what personal income. So you see that our personal income, our taxable income increases as a result of what capital gain. So let's go to the rent relief, rent paid rather. So the rent paid, if we see scenario that, okay, let's say our rent paid during the period is 3 million, we could see that, okay, we are going to have our chargeable gain reduces as a result of what of interest being claimed during the period. And at the same time, this interest is not automatic. You have to what? You have to make a written claim for it and provide documentary evidence before you can claim it. So it is important for you to note that. And let's see what is going to happen if we change our mortgage as well. Let's say our mortgage is we have a mortgage loan that was incurred. We have a mortgage that was incurred. So that mortgage, let's see what's going to be the effect. So let's change the mortgage. So we change the mortgage to, let's say, 500,000. As we change the mortgage to 500,000, what really happened is that our taxable income reduces to 8,275,000. So you could see, so the more you get as a mortgage loan you incur, the interest you incur on it is available for you at rent. But don't forget, under normal circumstance, rent relief, mortgage relief, they are what they are not applicable to every individuals. They are only applicable to those ones that incurred. If you are a person, you incur a loan, you incur interest or loan to build the house where you are going to be staying. That's when you can claim mortgage interest relief, and that of rent relief is only available for tenants. They are what? They are not applicable to every persons. They are not applicable to every persons. So that is being done. So let's now see what is going to be the effect on the of the chargeable gain. Let's see the effect of the chargeable gain and explain the tax rate on each of the tax band. And don't forget that the personal income tax are on progressive tax rate. So this progressive tax rate ensures that income of an individuals are apportioned into different social class. So let's see them one after the other. You are going to be taxed like you are taxing a low income tax earners, you are taxing a middle income tax earners, and you are taxing a rich and very rich individuals. So let's take them one after the other. Under the current regime, it is 300,000 naira. For the first 300,000, it is 7%. For the next 300,000 is 11%. For the next 500,000 above the initial 300 that has already been apportioned, it is 15%. And the next 500,000 above the 1.1 million, which is the sum of the initial 300 and 500,000, is attracting 19%. And the next 1.6 million is going to attract 21%. That 1.6 million being the amount in excess over the initial 500, 500, 300, 300, which is 1.6 has already been subject to tax. And anything above 3.2 being the what this the 3.2, anything above, it will mean that any income above that or above the already initial apportioned income will be subject to tax at 24%. Looking into the new tax regime, under the new tax regime, don't forget, under the current provision, it is only individuals that earn income from employment less than or equal to the minimum wage. They are exempted from payment of what? Of tax. Any other individuals, irrespective of your sources of income, you have to pay tax. Irrespective of your income, you have to pay tax in Nigeria. But only employees who earn at or below the minimum wage under the current regime that are exempted from tax. But the reform provision provides for every income earners, irrespective of your income, you are exempted from payment of tax so far you are earning at or below the minimum wage of 800,000. So every income tax payers who earns at or below 800,000 are now exempted from tax. You could see some enjoyments that you are enjoying. So we could see that. So under the new tax regime rate, the first 800,000 it is tax free. That is the tax rate is 0%. And the next 2.2 million, which is with next 2.2 million above 800,000, initial 800,000, it's attracting 15%. So we consider that is what the 2.2 million above 800,000, which is attracting 15%. So the next 9 million above the additions of that of 2.2 million and 800,000, which gave us the what? Which gave us 3 million. So the 9 million above 3 million is going to attracting that 18%. And the next 30 million, which is what? The next 30 million above the initial 9 million, 2.2 million, and 800,000, which sum up to 12 million. The amount of 30 million above that, it's attracting 21%. And at the same time, amount of 25 million above initial 13 million, 9 million, 2.2 million, 800,000, which make up of 25 million. So this 25 million in excess of initial 25 million that has already been apportioned is going to attract 23%. So anything above that, all the initial amount of money that has already been subjected to tax, anything above that is attracting 25%. That is above 50 million. If you add 25 million, 30 million, 9 million, 2.2 million, and 800,000 together, they are going to give you 50 million. So any income that is now and are not yet subjected to tax that is above this 50 million, they are going to be attracting 25%. You could see that it is equity. There's equity before the law, whereby we are being taxing just an individual based on the show in respect of each levels of each level of social class, from the middle income earners to the low income from the low income earners to the middle income earners to the rich income earners and to the very rich income earners. We are still going to see how these things look, the structures and the like. So let's start from the first one. by looking into what are the for instance, we have a chargeable income. So with the first chargeable income that we are having now, okay, we have 300,000. Initially, any person that is having a total chargeable income of 600,000, they are going to pay tax in Nigeria under the current provision. And the total tax we could see under for 360,000 is what? Is 27,600. And under the current tax provision, they are not going to pay any tax. They are what? They are paying nil. And that simply means we have the tax saving under the current provision of 27,600. So let's check another scenario. And you could see that you could see that there is no tax, there is no apportion for the first 300,000 under the current provision. For the first 300,000 is subject to tax at 7%. The next 600,000, next 60,000 above that 300,000, it's apportioned at 11%. And under our current regime, it is 0% because the income is not taxable at all. So let's see another scenario. We have 800,000. Under 800,000, under the current provision, the total tax you are going to pay is 84,000 naira. But under the new tax law, you are not paying any income because we consider you as a low income earners. So you will see that we still have a tax saving of 84,000 naira. So we have tax saving of 84,000 naira. The current tax provision is greater than that of the reform tax provision. You could see that. So we don't pay tax there. This simply means under the new tax regime, we should be seeing every individual that they are going to be seeing reduction in their reduction in the amount of the tax they are going to be paying. All to the reasonable extent. We are still going to see how these things work. Let's go to another one. You could see that for the first 300,000, next 100,000, the next 500,000, but this 200,000 is less than 500,000. That is why it's apportioned at 15%. So I'm still going to share you these Excels if you request for it. Let's see 1 million. You could see at 1 million, we are now going to be subjected to tax under the current provision. But the tax we are paying is 30,000 compared to under the new reform provision. The tax we are paying is 30,000. But under the current provision, we are paying 114,000. You could see that under the current provision, the amount of tax we are paying is reducing, So you could see this new tax provision provided that you pay lesser tax on your tax on the chargeable income compared to before. So let's say 5 million. Under 5 million, you can see we are paying 992,000 naira as tax liability under current provision. But under the reform provision, we are paying 690,000, and we have a tax saving of what? Of how much? Of 302,000 naira. You could see that tax saving of 202,000 naira, 302,000 naira. That's what the current provision is making. So we are paying lesser tax under the current provision compared to what? Compared to before. And let's say another scenario. We have 10 million. Under 10 million, we could see the amount of tax we are paying is 2,192,000 under the current provision. 2,992,000. But under the reform provision, we are paying 1.5 million and we have the tax saving of 200,000. You could see that the amount of tax we are paying, it is reducing compared to current provision. So let's go to 20 million. You can see that 4 million is that 4.5 million. That's the amount of tax we are going 4,592,000. That's what we are going to pay under current provision. But under reform provision, we are paying 3,630,000. That's simply we are going to be paying lesser taxes under the current provision. But we are going somewhere. Let's see 40 million. So 25 million, right? So 25 million, we are still paying lesser tax. So let's go to 40 million. We are still paying lesser tax. We pay 9 million under current tax regime, but under the reform tax regime, we are paying 8 million. You could see that our taxes is still decreases. Let's say that of 50 million, it is still decreasing. Amount of tax we are paying is decreasing, but we are still going to see how the summary of everything. So let's see that of 80 million. You could see that our tax also decreases. The amount of tax we are paying decreases. This is reasonable. It is what? It's good. So the new tax regime provide for what? Tax saving. You could see they were still saving, but the rate at which they are saving is started decreasing. We get at 100 million. And so 150 million as well, you are going to see tax saving. The tax saving is still on 362,000. We are still paying, the amount of tax they are paying is still reducing. So anything starting from 200 million, we are going to be having a tax burden. You could see that the tax liability under the reform provision is greater than the current provision. That simply means our what? We are now started paying higher whenever you start making your total income start increasing at reach 200 million, you are going to start seeing increase in your taxes. So let's see 300 million started from 200 million. You are going to start seeing increase in taxes. Started from 300 million, you are going to start seeing increase in your taxes. Unlike before, let's see 150 million. Under 150 million, which is what? That is what we are going to, which cap at 150 million. So we are still seeing a tax saving. You could see the current tax provision is greater than the what? Reform tax provision. So we are still seeing a tax saving here. But now, let's now see what is the tax summary. The tax summary, under the tax summary, using a comparative analysis of the personal income tax under the current provision and the reform provision, you could see that our tax saving continue to increase up to that when it reaches 50 million. When it reaches 50 million, it started decreasing until it reached 200 million and it became negative. This simply means that for low income tax earners, they are not paying any tax at all. They pay zero tax. You could see the tax saving, it is 100%. The current tax, the tax saving is 100%, using the tax saving as a percentage of the tax liability, the current tax liability under the current act. But when we say tax saving as a percentage of the total income, we see a what? A 7.67% tax saving. And this tax saving increases. But it started decreasing. Again, it started decreasing when it reached 1 million. You could see. So lower middle income earners, which earn at greater than 800,000, it is me that make these classes of income earners, not according to the government or the provision. But I make these classes for better understanding. So I consider anybody that is earning at or below the 800,000 as the low income earners. And anybody earning above 800,000 but less than or equal to 25 million, I consider them as lower middle income earners. So lower middle income earners, they still enjoy tax saving. You could see the tax saving started increasing. So the tax saving they still enjoy significant tax savings. But the tax savings reduces as the income rises. You could see the tax saving as a percentage of the what? Total income start decreasing. So as the tax savings increases, but the rate or percentage of saving start decreasing. So it increases, the tax savings increases at a decreasing rate. Now, but when we get to upper middle income earners, that's in the income earners that is earning above 25 million, but less than or equal to 50 million. So when you are earning above 25 million, but you are earning between 225 million, above 25 million, but is less than or equal to 50 million, we are still going to be seeing tax saving. You could see that under this 50 million, we are still having a tax saving. But our tax saving is still going to be reducing as the income decreases. But now, starting from this, we are not seeing increase in tax saving again. Our tax saving is increasing at a decreasing rate before, but now our tax savings is decreasing. Anytime from 50 million, our tax savings started decreasing. That's when I started consider them as the high income earners. So the high income earners, they are seeing the tax saving. Their tax saving they are also seeing tax saving. That is, they are seeing tax saving, but the tax saving is dropping sharply. So the tax saving is at a decreasing rate. The tax saving is what? It is decreasing. The tax saving decreases at a decreasing rate. Why? It decreases at an increasing rate, rather. The tax saving decreases at an increasing rate. Initially, when our income reaches before 50 million, it is the tax saving is increasing at a decreasing rate. But now, after 50 million, the tax saving starts decreasing at an increasing rate. So we could see that. So our ultra high income earners, they don't even see any tax savings. They started having what you call a tax burden. So there is a negative tax savings. So it is result in negative. That is additional tax saving. So they have a tax burden. The trend summary. So the low income earners, they start seeing say strong benefits. They benefit the most, and the benefit lower in middle income earners, the benefits, but benefits decreases as the income increases. And the same thing happen to the middle income earners. Their benefits start decreasing, continue decreasing as the income increases. But the high income earners, they started experiencing tax saving at a neutral, because you could see this at 0.2, at 50 million, 150 million. You can see that they have 0.2 tax savings as a percentage of total income, and they have 1.01%. It's more or less like neutral. But whenever they reach 200 million, any person earning at 200 million and above, they will start seeing an increase in their taxes. They are not going to be seeing tax saving again. They are going to be seeing an increase in their tax burdens. At 200 million, they are going to see additional increase of 138,000 naira for their tax burden. You could see that. So that is everything we have to know. So in general, the reform helped the low income earners, the low to medium income earners, but increasing the tax on the very high or ultra high income earners. So another thing I would like to address is filing of returns. Filing of returns is not mandated for every individual, every taxable person to file returns. Initially, their employer file returns in their regard. But now every employees are now mandated to file their returns irrespective of their status. So every persons now have to file returns. So I've been having a lot of people ask me questions: how am I going to file returns if I'm exempted at this? Okay, let me quickly address that. By addressing that, I'd like to start with non-taxable income. What is non-taxable income? Non-taxable income are income that do not meet the definition of taxable income, one, or income that meets the definition of taxable income but are exempted under the provision of the income tax. Now, let me take them one after the other. We have what we call, suffice to say that non-taxable income are divided into two. We have what we call inherent non-taxable income, and we have what we call the non-taxable income by exemptions. So, inherent non-taxable income, they are not required to file returns. For instance, you have a gratuity debt. That is, debts gratuity given to you. They are not required to file returns. You're not required to file returns. Or you are a student in which your mommy sent you money, your feeding fees and likes. It's not a taxable income because it does not constitute the definition of taxable income. So they are inherent not taxable income. Or you have a compensation for loss and for disability. Rather, for they provide you, your employer provide you a compensation. They give you some money because of disability or because of accident that occur in the place of work. So, as a result of accident or disability, such such compensation, they do not meet the definition of taxable income, because it's not as a result of economic activity. It's not because you work to earn it. So you are not required to file returns in that regard. But as regard what we call taxable income, every taxable income you have to file returns on their regard, even though if they are being exempted. So, like gratuity, normal gratuity under the provision of the Act, they are what? Under the provision of Pension Reform Act that are exempted, they are also, you are to file returns in this regard. How are they going to know the status if truly this gratuity that you mentioned, that it is what it meets the definition of what, of the provisions? For them to ascertain that, you have to file returns for them to see. So you have to provide the relevant information as regards to that. The same thing applicable to pensions. The same thing applicable to dividend. Dividend, it is a frank investment income. Income upon which further tax cannot be charged, but you have to declare return in this regard. And at the same time, every other taxable income, so far it is taxable income, so far it meets the definition of taxable income, you have to file return in this regard. It is only those income or those benefits that does not meet the definition of taxable income, like gifts as well. Gift is not taxable. Gift, it is what, it is not taxable, it does not meet the definition because you don't engage in any economic activities. So gift, it is outside the what, the taxable. So all these inherent taxable and inherent not taxable income, we are not expected to file returns in their regard. But everything that meets up with the definition of being taxable as an economic activities, or you earn from economic activity, we are to file returns in their regard. So let me stop for here. Subsequently, I'm still going to make up another class whereby I'm going to explain personal income tax in details, where we work in details. Thank you. My name is once again is Victor Olamide Atonda, and I'm delighted to have every one of you on board. Bye for now.